$10 a gallon. That is not a typo. That is the projected gasoline price ripping through the American Midwest within days, not months, after Canada pulled a single lever and cut 40% of crude oil exports to U.S. refineries. Michigan, Ohio, Indiana, industrial America on the brink of a price shock measured not in cents, but in economic pain. This is not a market accident. This is not a weather disruption. This is a policy failure. A reckless escalation that just detonated in Washington's face. Donald Trump threatened a 25% tariff on Canadian energy, framing it as toughness, as leverage, as energy independence. But what followed was not submission. It was retaliation. Cold, calculated, strategic. Canada shut down Line 5 operations and made one thing brutally clear. Canadian oil will not subsidize an economic war against Canada. And now the question Americans must ask urgently is this: how did the United States, the world's largest economy, manage to shoot itself in the foot over energy it cannot replace? Because this wasn't strength. This was a catastrophic misread of who actually controls the switch. To understand why this crisis matters, you have to strip away slogans and look at the hard mechanics of the energy system. The American Midwest does not merely buy Canadian oil, it is structurally dependent on it. Refineries in Michigan, Ohio, and Indiana are engineered around Canadian heavy crude. This is not interchangeable supply. You cannot simply swap it for Texas shale overnight. The sulfur content, density, and refining configuration are specific. When 40% of that feedstock disappears, production does not adjust, it stalls. Line 5 alone moves roughly 540,000 barrels per day, feeding not just gasoline but diesel, jet fuel, and petrochemical inputs. This energy flows directly into trucking, agriculture, aviation, and food processing. This is the backbone of just-in-time logistics, an unforgiving system with no buffer. The American energy myth says America is independent. The data says otherwise. Even today, Midwestern refineries source over half of their crude from Canada. Remove it, and marginal costs explode. Refineries either bid up remaining supply, driving prices vertical, or shut units entirely. And here's the trap Trump walked into. Energy markets are not political theater. They are margin-driven systems. A 25% tariff does not punish Canada. It is passed downstream instantly into fuel prices, freight rates, grocery shelves. When gasoline breaches psychological thresholds, inflation cascades. Transport costs bleed into everything: corn, beef, packaging, fertilizers. This is why the projected $10 per gallon figure matters. It is not about commuters, it is about systemic price transmission. And unlike stock markets, energy supply chains do not forgive disruption. Restarting flows takes months. Reconfiguring refineries takes years. No executive order fixes that. Canada understood this. Washington did not. What Trump framed as pressure was in reality a self-inflicted supply shock, one that exposed how fragile the American industrial core really is when its upstream dependencies are weaponized. This was not a gamble. It was an economic miscalculation of historic scale. And the worst part? The damage was predictable. This is where Trump's aggression turns into domestic betrayal. The immediate victims are not politicians in Ottawa. They are American households and American industries, starting in the Midwest and spreading outward like a shockwave. Michigan's refineries are already signaling emergency operating conditions. Ohio's fuel distributors are warning of spot shortages. Indiana's logistics corridors, some of the busiest freight arteries in North America, are staring at fuel costs that make trucking contracts mathematically impossible to honor. And here's the brutal truth Washington doesn't want to say out loud. There is no Plan B. U.S. shale cannot fill the gap. Rail capacity is insufficient. Marine imports cannot move inland fast enough. Strategic reserves are politically radioactive and logistically misaligned for refinery grade. The system is cornered.
An executive at a Midwestern refining consortium put it bluntly in an emergency briefing last week. This isn't a price spike. This is a supply break, and supply breaks don't negotiate. Gasoline crossing $10 per gallon is not just a headline, it is an inflation accelerant. Grocery prices surge within days. Food processors pass costs immediately. Cold chain logistics for meat and dairy tighten. Farmers face diesel bills that wipe out margins before planting even begins. Look at the electoral map. Michigan, Ohio, Indiana, Wisconsin, Pennsylvania. These are not coastal states insulated by finance or tech. These are industrial swing states, the very states Trump claims to defend. And they are now staring at voter rage driven by fuel bills, heating costs, and layoffs. The American trucking associations have already warned that sustained diesel above crisis thresholds will force capacity withdrawals. Fewer trucks, slower deliveries, higher prices, empty shelves. This is how economic wars backfire, not with explosions, but with compounding friction. And here's the most damaging irony of all. Trump sold tariffs as protection, but energy tariffs don't protect domestic producers when infrastructure is mismatched. They punish consumers and cripple downstream employers. Every refinery slowdown ripples into steel, autos, chemicals, and agriculture. A senior Midwest agricultural cooperative summarized the mood perfectly. "We were told this was about strength. It feels like we were volunteered as collateral." That is the political cost Trump underestimated. Energy dependence doesn't care about rhetoric. It only cares about flow. And when Canada turned the valve, America learned, too late, who was really holding leverage. While Washington was shouting, Ottawa was building exits. Canada did not improvise this response. It executed a strategy that had been quietly prepared for years, one designed for the exact moment the United States became unreliable. The suspension of Line 5 was not the real move. The real move was diversification. Within days, Mark Carney confirmed what energy markets had already detected. Canada had activated priority crude supply agreements with Europe and India, routing volumes through newly expanded West Coast export terminals. This is not symbolic. This is structural. Canada has been investing aggressively in port capacity, rail links, and storage on the Pacific Corridor. New crude handling facilities in British Columbia allow Canadian producers to bypass U.S. pipelines entirely. Tanker access to Asia and Europe is no longer theoretical, it is operational. And here's the part Washington missed. Canada does not need to replace the U.S. overnight. It only needs to prove it can. Energy buyers in Europe, burned by Russian dependence, are desperate for politically stable supply. Indian refiners are hungry for long-term contracts insulated from U.S. political volatility. Canada offers both, scale and predictability. Mexico, watching closely, has also begun aligning quietly. Cross-border energy coordination is shifting south and west, not north. The old North American energy triangle, U.S.-centric and pipeline-bound, is being redrawn. This is economic statecraft, not retaliation. By redirecting flows, Canada sends a message that terrifies markets. Once infrastructure pivots, it rarely pivots back. Pipelines rust, ports compound, contracts lock in. And the most dangerous phrase for Washington just entered the conversation: non-U.S. pricing benchmarks. Canada is no longer pricing energy as a captive supplier. It is pricing as a global exporter. That alone rewires leverage. Trump framed tariffs as dominance. Canada answered with irreversibility. The moment crude starts moving reliably west instead of south, American refineries lose more than supply. They lose negotiating power. The Midwest becomes a price taker in a market it once assumed it controlled. This is why Canada stayed calm. This is why there were no threats.
Canada wasn't reacting. It was leaving. And once energy divorces infrastructure, reconciliation becomes extremely expensive, if not impossible. This is where the damage becomes permanent. Energy systems are built on trust, predictability, and long timelines. Once a supplier decides a customer is politically unstable, that relationship is functionally broken, regardless of who occupies the White House next. Washington miscalculated one core truth: credibility, once lost, is never fully restored. From Canada's perspective, this crisis confirmed its worst fear, that U.S. energy policy can be weaponized overnight for domestic politics. That means every future American promise now carries a risk premium, and markets hate risk more than tariffs. Even if Trump leaves office tomorrow, the lesson remains. Canadian policymakers will ask, what stops the next administration from doing the same thing? The answer is uncomfortable: nothing. That is why infrastructure decisions made today will shape trade flows for decades. Once capital shifts west into ports, tankers, and transoceanic contracts, those assets demand utilization. No finance minister builds redundancy just to be nice to Washington. This is how power erodes, not with defeat, but with irrelevance. And the beneficiaries are already obvious. Europe gains a stable alternative supplier. India locks in long-term energy security. Meanwhile, geopolitical rivals like Russia and China quietly enjoy the spectacle, an America undermining its own alliances while preaching strategic competition. The so-called strategy of energy independence collapses under its own contradiction. Independence does not mean isolation, it means resilience. And resilience requires cooperation. Instead, the United States signaled volatility. Global partners are adjusting accordingly. Contracts are being rewritten, risk models recalibrated. The U.S. dollar still dominates, but energy trade no longer assumes American centrality by default. This is the real shift: not higher gas prices, but diminished influence. Trump believed leverage came from pressure. The world is relearning that leverage comes from being indispensable. And once a country proves it is optional, the damage outlives any presidency. History is unforgiving on this point. Empires do not fall when challenged by enemies. They fall when allies stop trusting them. Power is not measured by how loudly you threaten. It is measured by how many people choose to depend on you, willingly. This crisis was not inevitable. It was engineered by arrogance, miscalculation, and a fundamental misunderstanding of modern economic warfare. The United States believed it could coerce a partner without consequence. Canada proved that control, not size, determines leverage. When energy becomes a weapon, alliances become liabilities. And when trust is shattered, supply chains don't recover, they reroute. The most dangerous outcome is not $10 gasoline. It is the silent realization spreading through global markets that America is no longer the safest anchor. So, here is the question that will ignite the comment section. Did Trump just expose America's strength, or did he permanently weaken it by proving that even its closest allies must plan an exit? Because once the switch is flipped, there is no guarantee it ever flips back.